Markets have emerged as one of fintech's fastest growing segments, with monthly trading volumes reportedly surging from roughly $100 million to over $13 billion in just 2 years. Platforms like Polymarket and Culture allow users to wager on binary outcomes spanning politics, economics, as well as pop culture. While these markets demonstrated notable forecasting accuracy during the 2024 US presidential election, significant structural challenges remain before they can transition from speculative venues to credible financial instruments. Key obstacles include the insider trading vulnerabilities, fragmented regulatory oversight, and persistent liquidity constraints that undermine price discovery. The focus of this video is going to be on prediction markets, and today we are going to be talking about how they can transition from betting platforms to financial infrastructure. Let's first start with the theoretical promise out here. Now, prediction markets operate on a very compelling premise. By requiring the participants to stake capital on their beliefs, these platforms aggregate dispersed information into probabilistic price signals. Now, this mechanism theoretically harnesses collective intelligence more effectively than the surveys or expert panels, as participants bear direct financial consequences for inaccurate forecasts. The model has gained traction during a period marked by information overload and heightened geopolitical uncertainty, where traditional forecasting methods have struggled to keep pace with rapidly evolving conditions. However, there are integrity concerns and information asymmetry challenges. The sector faces serious credibility challenges stemming from insider trading and market manipulation. Next, let's also talk about the liquidity limitations and the market depth. Now, even as the trading volumes expand, many prediction markets suffer from insufficient liquidity. Thin order books weaken the reliability of price signals, facilitate manipulation by well-capitalized actors, and restrict the utility of these instruments for genuine hedging purposes. Large institutional participants cannot establish or exit positions without materially distorting the prices, a limitation that undermines the platform's viability as risk management tool. Major trading firms have responded by deploying quantitative analysts to exploit arbitrage opportunities arising from pricing inefficiencies across the related contracts. And this brings us to two important questions. Where does the real value lie, and what can be the path to maturation? Let's start with where the real value lies. The most promising applications for prediction markets likely center on economic event contracts rather than celebrity gossip or novelty wagers. Contracts tied to inflation data releases, central bank interest rate decisions, or specific policy outcomes could generate targeted price signals and customized hedging instruments that are difficult to replicate through existing derivatives market. Now, such applications would position the prediction platforms as complements to the traditional financial infrastructure rather than competitors or entertainment venues. And when we are talking about the path to maturation, for the prediction markets to fulfill their potential as legitimate financial instruments, several conditions must be met. Regulatory clarity is essential both to establish credible enforcement mechanisms against manipulation and to provide operators with stable operating frameworks. Deeper liquidity pools will also be necessary to improve price discovery and accommodate institutional participation. Without these developments, the sector risks remaining characterized more by speculative noise than by reliable informational value. The distinction between a casino and a financial market ultimately rests on the quality of the rules and the rigor of their enforcement.